Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, the stock market is now up 25% in the second year of the bull market, but most on Wall Street expect the good times to extend into at least another year. The average price target for the S&P 500 index among major firms is now 6,600, which would be a 10% return, well under this year, but still around the average annual return for the index. Against this optimism, there is no denying that stocks are getting expensive, with a price of 28 times the earnings for all the stocks in the index. So you'd be forgiven if you're having a tough time finding good deals on new stocks to buy right now. But the good news is, you don't have to always find new stocks to buy because the best are often already in your portfolio. In fact, the 5 stocks I'm buying this month were right in front of my nose with a 38% return already, and I think more on the way. I'll reveal those 5 stocks to buy along with important updates to shares of UiPath and Salesforce. But first, Cyber Monday is here and the malls are filling up. Early holiday numbers show shoppers spent $6.1 billion on Thanksgiving alone this year, an increase almost 9% from last year. Now we all love a good deal, but you gotta ask yourself, is that $5 combo toaster foot massager really gonna make your life better? That's why I compiled a list of investing deals, exclusive discounts, and freebies to grow your wealth that's going to buy you the freedom and peace of mind you really want. Check out the video description below to find coupon codes for 50% off our stock trading course or to save $150 off the options investing course. Another will get you a free bond when you invest $50 on worthy bonds, and another will get you access to pre-IPO stocks before the market, so check that out below. In the stocks I'm buying this month, I'm following 2 of the most important rules of investing, but also 2 that aren't always easy to follow. First is that idea of investing in what you already have rather than always feeling the need to find that next hot stock. Nation, I know it can be tempting to chase after those new stocks everyone is talking about, but the stocks already in your portfolio are the ones you know best. You did the research before you bought them, you followed the news, and you're starting to get that experience into how their industries work, and that only comes with time. This means it's in these stocks that you're going to be able to see the best ones, the ones that are dominating their industry with a competitive advantage and which may be falling behind. And the second rule, and this one is just as difficult to follow, but also just as important, is to chase your winners higher rather than following the losers lower. Avoiding losses is a powerful urge, and that urge tells you to buy back into a stock when it's fallen 20 or 30% just to lower your average cost to help you get back to even if the stock rebounds. The problem is, the market with its millions of investors is pretty smart. A losing stock is usually that way for a reason, and a company falling behind its peers usually continues to fall behind. You can follow a stock lower for years, throwing good money after bad and losing a lot of sleep. Instead, folks, you gotta fight that urge to get the good deal and don't fight the market. Winning stocks are also that way for a reason because the company has some kind of competitive advantage it's using to gain that market share against its peers. Look for those winners and follow them higher. Now, this doesn't mean I'm buying everything in my portfolio just because it's up. Sometimes a stock price just outruns its fundamentals, and you have to wait for a better price. I want to highlight the 5 stocks I'm buying, but stick around and I'll reveal 2 that I'm just holding off on for right now. First up here, one that doesn't get the attention it should, Shopify Inc., ticker SHOP, which I started buying September of last year, now up 90% on my average cost. And I say average cost here because just like this month, I've continued to buy this regularly following the stock higher. Where Amazon is leading in the e-commerce market for its own website, Shopify helps businesses sell from their own sites and is a runaway leader in the market. Shopify controls 27% of the e-commerce website market, well above its next competitor, WooCommerce, at 19% share. And that e-commerce market still has a lot of growth left, with online sales just 15% of total retail sales in the US and even lower globally. It's a fraction of the $404 billion addressable market just in Shopify's core geographies. And as that market leader, Shopify is going to continue to get the lion's share of the growth. I started buying CrowdStrike Holdings, ticker CRWD, earlier this year and more aggressively after the outage. Shares are now up 60% off the July low, and I wish I had bought more to add to my 28% gain. CrowdStrike plays into my favorite growth theme over at least the rest of this decade, if not longer, cybersecurity. Everyone wants to talk about the promise of AI, quantum computing, and even fusion energy, but cybersecurity is the one theme that is already delivering on massive growth and will continue to do so. Growth is already there with a 20-fold increase in the number of malicious programs just since 2014, and at a cost of tens of millions to recover from a single cyber attack. companies are spending big to protect themselves with double-digit growth in budgets. CrowdStrike's leadership is on its software's ability to work on a multi-tenant basis across endpoints and has a clear tech advantage in its Falcon platform. Even if its quarterly report was a little disappointing last week, it was because investors just didn't have the patience to wait for that revenue wave expected late 2025. So for those that can wait, this one will deliver. This next stock I'm buying is one people said I was nuts to start, Super Microcomputer, ticker SMCI, buying first in October, then mid-November when the shit really hit the fan. I won't go into the full analysis I did on the channel about the allegations, but none of the problems or those allegations were a threat to the company or its leadership in the hottest growth story right now, the data center build-out for AI. I'm up over $100,000 on my position, and while the easy money is probably made at this point, and there's still short-term downside risk while the company prepares those late financial reports, the long-term upside is still to $50 and $100 a share. This is a company booking 20% plus growth, trading at just 17 times on a price to earnings, and just 1.4 times revenue. Deep value territory. Next here, we're back in that cybersecurity theme with Palo Alto Networks, ticker PANW, one of the largest companies in the group at a $126 billion market cap. I started buying Palo Alto this year with the other cybersecurity stocks, and I'm up 24% on my cost basis. And as one of the largest, it has the scale to provide those all-in-one enterprise security solutions and is trusted by companies and governments worldwide, with over 65,000 customers. Analyzing the theme earlier this year, Palo Alto struck me as a good balance between that growth and valuation. It's not the fastest growing among its group, but solidly upward and at a valuation that's well under more expensive peers. Another stock I'm buying, Zscaler, ticker ZS, one of my first cybersecurity stocks, recommending it first in 2019 at just $20 a share. Now, I'll admit, I got scared and sold out early at $160 in 2020, but started buying again last year, and I'm now up 20% on my average cost for a long-term position. Shares did come down on its last quarterly report on a disappointing outlook, but the company recently announced a partnership with CrowdStrike that could solidify that leadership and the growth with it. The two are launching a new set of AI and zero-trust integrations into CrowdStrike's Falcon software to coordinate threat sharing, detection, and response. Now, Zscaler's Zero Trust Exchange and CrowdStrike's Falcon software, it's each of the company's competitive advantage in the industry, and so combining them, I don't think there's another company that can beat that. Now, those of you out there in the nation are probably going to be a little surprised that I'm not adding to my position of SoFi Technologies, ticker SOFI. I have been an aggressive buyer since 2022, adding on any dips, and it's one of my best returns, and by far the biggest profit, almost $250,000. But just as I pointed out that the company's valuation around 0.9 times book value when I started buying as just ridiculously low valuation on a bank growing this fast, now I have to look back at the current 2.8 times book value and think it's just run too far. The bank still has some solid growth ahead of it, but compared to these other banks, even as that growth, there's no reason to pay 2.8 times book value when you consider Ally Financial, ticker ALLY, is trading at under 1 times book with a solid growth of its own. Another one of my stocks that I'm holding off right now has gotten a lot of kickback from investors. Shares of Palantir Technologies, ticker PLTR, up 150% on my average cost, and up 430% since recommending it on the channel 2 years ago. Now, don't get me wrong, Palantir is still a strong growth stock with 25% revenue growth expected this year and next, but let's step back and consider this. Shares are trading for a price that is 330 times the earnings the company generates, 60 times its revenue. Well, you say it's worth it for a company growing so fast, but you got to compare that to Nvidia even, which is expected to grow revenue by 50% next year. That's double Palantir's growth. And shares are just trading at 53 times on that PE basis and 30 times revenue. Or even AMD, which is expected to post 28% revenue growth next year, on par with Palantir, but is trading at a third the valuation, just 120 times on that price to earnings basis, and just 9 times its revenue. And folks, I know that realism might piss you off, but before you start bitching in the comments that someone is talking negative about a stock you own, understand the market doesn't run on rainbows and unicorns. I am not here to blow smoke up your ass and tell you your stocks are only going to go up forever and always. I call it as I see it from over a decade as a professional analyst and 25 years investing myself. Don't get emotional about your stocks. Step back, analyze them with a clear mind, and yes, follow your winners up. But don't get caught up in the herd mentality because you're only going to get crushed in the stampede. Looking at the stocks I'm watching this week, Salesforce, ticker CRM, is set to report its earnings on Tuesday after climbing 51% since the sell-off following last quarter's earnings. The company is expected to post $2.45 a share earnings on 7% sales growth, just under the 8.6% revenue pace it's expected to hit full year. Now, while I think the stock leads in the kind of AI assistants that are getting a lot of attention right now, we're not out of the weak period that CEO Benioff warned us about in last quarter. That could set the stock up for another disappointment on its earnings, but I'd be buying on any further dips here. Also watching HP Enterprise, ticker HPE. It's going to be reporting its earnings on Thursday, with investors closely watching its cloud and server solutions business, following that disappointing report from Dell last week that saw its shares down 14% on the day. While Dell and HPE are benefiting from those troubles at SMCI and a boom in that data center hardware demand, neither are really that pure play on the theme and are being held back by slow growth in other segments like laptops. I'll be watching HPE to see how those results differ from Dell and which appear to be benefiting most from that growth in server demand. UiPath, ticker PATH, also reports on Thursday, with investors still waiting for this disruptor stock to prove its growth potential. The robotic process automation company is in a strong growth theme driven by that potential for AI, but is only expecting to grow sales by about 9% this year and 11% next. Your shares are not expensive after a 42% plunge this year, and any good news could send it much higher. Showing you that big picture here with the Sector Spiders Sector Tracker. 10 of the 11 stock sectors closed higher last week, with energy stocks the lone laggard on a 4.6% drop in crude to $68 a barrel. Now, a ceasefire in Israel and potential negotiations in Ukraine have ratcheted down those geopolitical risks on oil, and record high production here in the United States is oversupplying the market. Energy stocks are still cash flow positive, but could fall further until crude finds support really around $60 to $65 a barrel. Technology stocks were also noticeably absent from leadership last week as relatively expensive sector takes a backseat to some of these other stocks. I'm also watching consumer discretionary stocks because it could do well over the next month, as are those early holiday shopping numbers show people are still spending. Shoppers spent that record $6.1 billion on Thanksgiving alone this year, an 8.8% increase from last year, and early Black Friday numbers are also showing strong year-over-year increases. Mobile purchases made up 60% of those online sales, which were up 10.5% from last year. Now, the consumer discretionary stocks in the S&P 500 appear to have had a good year until you look under the hood. That 24% year-to-date return is just under the 26% return for the broader market. But looking at the individual stocks in the sector, you see most of the upside has been due to 36% upside in Amazon and almost 39% return in shares of Tesla. Those two companies combined account for nearly 40% weight of the sector. So without those two stocks, the other 48 companies would have posted a feeble 9.3% return and really underperformed the rest of the market sharply. So there are still some good deals among the group. Don't miss those cybersecurity deals to grow your wealth. Look in the description below for exclusive coupon codes and offers I found for the Bowtie Nation. Get that stock trading course for half off. Save $250 or save $150 on the options course, both with a 14-day free trial. Get a free bond on Worthy when you invest $50 or invest in pre-IPO startups with the Linkdo platform. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.